What's going on, ZCommunity cuties? It's your boy Azizz Finance, and welcome back to the Personal Finance in Canada show, also known as the PFC show. Whether you've been listening to our podcast for a while now, or this is your first time, be sure that you're either following or subscribe to the pod, and share this with somebody who you think will also get value from this podcast as well. Now, without further ado, let's get this party started and dive into the episode. By listening to the PFC show, the Personal Finance in Canada show with Azizz Finance, you acknowledge and agree that me, Azizz Finance, assume no responsibility for any financial decision or decisions that you make, as it is ultimately your finances and you are the only controller of your own decisions. I am a random person on the internet and not a financial professional, so please consult with one being a financial professional before making any financial-based decision, because anything that you hear on this podcast, overall, each and every single episode, is just a sharing of my experience and are not suggestions whatsoever, regardless of the types of language or words that I use within these episodes. Again, by listening to this podcast, you acknowledge that I assume no responsibility for any decisions that you make regarding your finances. Alright, so you've probably seen on some of the headlines or even news reports that Canada has seen the largest inflation rate for the past few decades now. And considering this, I thought I'd make this episode to talk about inflation-safe investments. How to protect your investments or even your cash against inflation, especially in times where they are extremely higher than average. So to actually break this down, I feel like it's a good idea to talk about what inflation actually is. Now, inflation is just fancy lingo for the phenomenon of a specific currency decreasing in value. In human terms, this just means that a dollar today is not going to have the same worth tomorrow. So when you hear headlines that are basically telling you, oh my god, inflation was 4% last year, this just means that the dollar that you had made last year is going to be worth 96 cents for the upcoming year. Now, considering this, how does inflation affect our day-to-day lives? Now, for us consumers, inflation actually causes prices to increase all across the board. So this could be your grocery bills increasing. Whether you're buying your milk, your eggs, your meat, whatever the case is, you're going to notice that prices have significantly gone up. Even if it's a little bit, it's caused by inflation. Now, because this is only a small amount, and usually we don't really see high inflation rates every single year, you won't really notice this on a year-to-year basis. But if you were to compare your bills, say for example, from 5 years ago, from 10 years ago, you're going to notice that there's a pretty significant difference. Now, how do you know what's considered to be higher than average or lower than average? Well, looking at the historical data, there has been an average inflation rate of about 2% per year. And believe it or not, this is actually pretty healthy for an economy to keep growing at a good rate. This means a dollar every single year is going to decrease by 2 cents. And obviously, because this is just the average, there will be times where it is lower and some times where the inflation is higher. Now, inflation and its effect on our investments. Now, we have to look at this from a few different perspectives, because obviously investments are not just stocks, right? So let's look at our first case scenario of how inflation affects stocks. Now remember, stocks are basically representing pieces of a certain company. So when it comes down to the things that go on in a company, you have to consider that companies have cost of goods. So taking, for example, a company that manufactures construction goods, whether that be wood, steel, you name it. So when it comes down to this company needing to manufacture these, it has to source these specific materials from other countries or other companies. And when inflation hits, usually they have to see an increase in how much it actually costs to buy these materials out. Now, obviously, in order for the company to stay growing, it needs to remain profitable, at least at the same profit margin that it makes, or even increase it. So in this case, the cost of wood actually ends up increasing. Now they're going to pass over that cost over to whoever they're selling these construction materials to. And that is one case scenario of how we can see inflation affecting these companies. Now, looking in the short term, there will be short to medium term earning decreases. And this basically just means potential decrease in stock prices. So in times where, inflation is a little bit higher than usual, within that same year or usually the year after, the company will report earnings that are usually a little lower than expectations. And when this happens, there might be potential decrease again in the stock prices, which then translates to a lower portfolio size
within any stocks or any other companies that you hold. Obviously, this is going to be on a case-by-case scenario. So for example, tech companies won't face as much as a construction company, for instance. And that's really one way how inflation will affect stocks. Now, let's just say that you're somebody who is more on the conservative side of the investing world and you're into bonds. Now, bonds are a little bit trickier because there is no direct correlation between inflation and bond prices or the interest rates that bonds give you. It's more of an indirect relationship per se. And hear me out. Now, bond prices are directly affected by interest rates that either the Federal Reserve or, if you live in Canada, the Bank of Canada declares for that year. So for instance, if the Bank of Canada comes out and says that the interest rates are going to increase, this will actually decrease the price of bonds. Alright, so a lot of you guys have asked me, hey, Azizz Finance, how have you managed to create full-time income from options trading? Now, guys, I'll be quite candid with you. 99.9% of the entire platform is for free. All the education, all the resources that you'll ever need. Although you can get an inside scoop of what my trades look like on a day-to-day basis, and you can do this with our Instagram close friends subscription. Basically, for a small fee a month, you can get access to the day-to-day plays that I make on the Instagram story. It's as simple as that. So be sure to check out what this looks like and how you'll be able to benefit from this on our website, azizzfinance.ca, AZIZZ, finance.ca. If you're interested, let me know and you can get the inside scoop on the trades that I make to bring me my full-time income. Anyway, back to the episode. And vice versa, obviously, if they come out to announce that interest rates are going to decrease, then the price of bonds will end up increasing. What this actually means in layman's terms is when they say interest rates are going to increase, this means that the cost of borrowing is going to be more expensive. Think of it as you're getting a mortgage for a home. You want interest rates to be as low as possible so that whenever you're paying your mortgage, the interest that you pay is as minimal as possible and you're paying more of the principal. But back to bonds. An increase in interest rates, decrease in bond price, and vice versa. Now, the interest that's actually paid out by the bonds, also known as a coupon rate. Now, this usually stays the same, but the interest rates that are declared by the Bank of Canada dictates whether or not investors will actually get into bonds. Now, if inflation increases, the interest that you get from the bond will have decreased value, which isn't as attractive even for the safe investment. For instance, let's just say a bond is given out $1 for every single bond that you hold, right? I'm putting this in simple terms so you guys can kind of understand this. Now come forth next year and then we end up saying that, inflation is 4%. That bond that gives you $1 actually isn't really giving you $1 anymore. It's really only giving you 96 cents because of inflation. So essentially, the higher that inflation is, the less incentivized investors are going to get into bonds, which essentially will either keep the price as is or it actually might even decrease. If this doesn't make too much sense, shoot me a message and I'm more than happy to kind of clarify it, because when it gets to the bond world, we haven't really touched up on this too much, so I'm more than happy to clarify that for you. Now, real estate, on the other hand. Now, with real estate, this is likely the only situation where inflation actually is your best friend, because all factors aside, higher inflation results to instant appreciation. And of course, there's some exceptions, but if the inflation rate, again, was 4%, your home's value has instantly went up by 4%. Obviously, this would be a double-edged sword if it's the house that you live in, but again, real estate that you live in my opinion, is not considered as an investment in my eyes and is more of a liability. Now, when it comes to the case of loans, now we touched up on this before talking about bonds, but usually with higher inflation, there is a tendency for interest rates to increase, which is not good for loans. Because again, higher interest rates disincentivize borrowers across the spectrum to take out loans. For companies, this may mean lesser than usual loans taken out to grow the business, and for individuals, this may mean lesser incentives to take out loans to either invest in real estate, spend on your line of credit, or things of the like. So all in all, how do we really protect ourselves while still investing? Now, overall, protecting yourself against inflation has to be taken more from a proactive standpoint rather than a reactive one, because the latter would be way too late to actually take action. Now, depending on the type of investment that you're in, this is going to look different. So for stocks, ultimately, dollar cost averaging is going to be your best friend, and making sure that this is within highly diversified investments. What this means is that you have a couple of stocks that are within, the real estate sector, the materials sector, consumer cyclicals, things like that. That's really the only way to kind of curb inflation with stocks. Now, if you don't really know what dollar cost averaging is, aka DCA, well, it's two acronyms in one. Anyway, now dollar cost averaging is just dedicating a consistent amount on a consistent basis, which over a long run is going to decrease your average cost. What the hell does this mean? In simple terms, if a stock was trading between $1 and $10 over the past 5 years, but you kept investing a consistent amount every single month since the beginning of those 5 years, you'd actually have an average cost price of around, let's just say, $5. Because, throwing it back to simple maths, $1 plus $2 plus $3, all the way up to plus $10, divided by 10 gives you a 5.5 average. It's just the law of averages, but I'm pretty sure we have an episode that touches up all about dollar cost averaging. So be sure to check it out if this is your first time hearing about this concept, as it is the only safe haven for protecting yourself against inflation for stocks. Sector-wise, in case you don't know what that is, it's just different industries of an economy. It's not really a wise move to have all your investments in technology, for example, because if something happens to that sector overall, say goodbye to your portfolio. But on the other hand, if you're spread across different sectors such as technology, gold, energy, real estate investment trusts, or REITs, for instance, a decrease in one or two of the sectors should be balanced out by the other ones that wouldn't have seen a crazy decrease, or in some cases it might even increase. Now for bonds, I feel like the only way to really protect yourself against inflation with bonds is to really just look into long-term municipal bonds, because really they offer the highest interest rate, which is likely to beat inflation in the long run. So for instance, if you're getting paid a coupon rate of 5 to 6% a year, you'll be beating the average inflation of 2% per year. Now, protecting yourself against inflation with real estate is actually pretty interesting. Now, I don't know if you guys have already gotten yourselves into properties and mortgages, or it's still something that you are considering, but nonetheless, when it comes down to purchasing a property and getting a mortgage, you want to make sure that you're always looking to buy in low interest environments. And when you do this, you need to make sure that you're looking at fixed rate and long-term mortgages. So for example, payoffs within 20, 25, 30 years, and making sure that you're locking in that fixed rate in comparison to variable, for example. Now, the difference between these two is that variable rates are going to change based on whatever the Fed or the Bank of Canada announces, and that could really mess you up in the long term, because let's just say you got your mortgage while, low interest environments, things were looking beautiful. But then a few years later, Bank of Canada comes out and says, oh, we're increasing interest rates by 1%. Well, guess what? With a variable term mortgage, your interest rate is going to increase, which increases your monthly mortgage payments. Whereas with a fixed rate mortgage, your interest rate doesn't really change unless it's time to actually renew it, or you're refinancing, or whatever the case is. And low interest environments, again, should be pretty self-explanatory. The lower that you can get, the more that you'll be saving, and the less that you'll be spending on a more monthly mortgage payment. And really the exact same thing applies with loans, as mortgages usually fall under this section of real estate as well. Now, for low interest and high economic prosperity environments, I highly recommend hitting up all of your lenders to negotiate your rates if possible, as these negotiations usually last for a while, unless stated otherwise in the agreement that you guys usually have set out together. Alright, ZCommunity, that's pretty much it for today's episode. Now again, if you did find value from this, be sure that you're either following or subscribed to the podcast so that you're up to date with new episodes that are going to come your way. On top of that, if you feel like either your friend, your parents, your grandma, your grandpa are going to benefit from this episode or this overall pod, be sure you swing it their way, because at the end of the day, it could just be a nice little early Christmas gift or something. But nonetheless, guys, it's your boy Azizz Finance signing out. I'll see you guys on the next one.